This is task 2 from the second sample assessment for business tax. Task 2 is about capital allowances. So let's look at the first part of the question. We've got quite a bit of information here, so let's have a look at the requirements first of all. So in part A, calculate how much of the expenditure will be eligible for structures and buildings allowance, and state your answer to the nearest pound. So structures and buildings allowance is a type of capital allowance that gives us tax relief when we spend money on structures and buildings, but not on land, and also this excludes any costs for planning permission. And then part 2, calculate how much the allowance will be in the year ended 31st of March 2025, and the allowance is going to be worked out at 3% straight line over the life of the building. So let's have a look at the information then. So Harry and Kiki are partners in a partnership, Harry & Co, preparing accounts to 31st of March each year. The partnership has opted to use the accruals basis of accounting. Harry & Co are building a warehouse for their business. The construction commenced on the 1st of August 2024 and was completed on 31st December 2024. The warehouse was brought into use on the 1st of January 2025, and that's significant because that's when we can start to apply the 3% allowance. So we'll need to do a bit of time apportioning here, so there's only going to be 3 months where we can use the allowance. The remaining time is just going to be us building up our costs. And then we've got a list of the various expenses here. So we can see on the 1st of May we bought the land. Well, land is not a structure and it's not a building, so we're not going to include that. And then on the 15th of May we have the planning permission, which is not allowable for structures and building allowance. And then the other 3 expenses, the building design, site preparation and construction, they're all okay. So we can just add those together and that gives us our total expenditure of 213,500. And then how much is the allowance going to be? So we can take our 213,500 and we multiply by the 3% allowance. And that gives us 6,405, but the building only came into use 3 months before the end of the year, so we need to time apportion this and multiply by 3/12, and that gives us an answer of 1,601.25, but in the question we need to round to the nearest pound, so it's going to be 1,601. Let's move on to the second part of the question. So we've got quite a bit of information here. So let's just sort of scroll down to see what we need to do first of all. So complete the capital allowance computations for the period ended 31st of October 24 and the period ended 28th of February 2025. Okay, so we've got 2 different periods to deal with here. The brought forward figures for the 1st November 23 have been entered already. Okay, so we can see there's our table. It's quite a big table. There's plenty of space here for you to be able to enter your figures. So that's quite nice. But we've got a brought forward figure for our general pool and we've got a brought forward figure for our special rate pool. So that special rate pool would be used for basically not very clean cars. Okay, so let's have a look at the information now then. So Company X prepared accounts for the 16-month period ended 28th of February 2025. Okay, so that's why we have to do 2 periods in our answer here, because we have a long period of account. We've got 16 months. Okay, so we need to divide that into a 12-month period and then a follow-on 4-month period. Okay, we can't just do it for 16 months. So we're told that the tax written down value at the 1st of November were those 2 numbers, and they've been put into the answer for us already, haven't they? So we don't have to worry about that. And then we're given some information about additions. So the dates here are relevant because the first 2 additions are going to fall in the first 12-month period, and then the 3rd addition is going to be in the second 4-month period. We also have a disposal as well, and that's going to be in the first 12-month period. And they're also told Company X will make claims for capital allowances which bring the most benefit to the company in the current and future periods. So that's basically giving us a hint that we should take 100% allowances early on as much as we can. So there's our table, and notice we've got a variety of headings here. So we've got our AIA. So this is the annual investment allowance, which is a type of capital allowance, but it gives us 100% tax relief in the year of purchase. But there is a cap of £1 million of this, and if we have a long period of account like we have now, we can prorate that up and down for sort of longer periods, but that's not going to be relevant in this particular question, because the plant that we've bought is actually below that 1 million. So what can we include in here? So we can include plant and machinery, integral features, long life assets and private use assets, but we cannot include cars and we cannot include structures and buildings in the annual investment allowance. And then in the next column, we've got the first year allowance for cars. So this is where we have zero emission cars, and we can get 100% allowance on zero emission cars. And then in the third column, we've got first year allowance full expensing. So for companies, they have this full expensing. So again, they can take 100% of the cost and just write it off in the first year. And what's good about this is that there is no cap like there is for the annual investment allowance. But this only applies for new plant. It can't be second hand. It must be acquired from a third party, so nothing in the group. It cannot be purchased for the purpose of leasing, and it may not include cars. So that all sounds very good, doesn't it? The one disadvantage with the full expenses model is that when we dispose of the asset, if there is nothing in the general pool, then it would create a balancing charge. Whereas if we use AIA, all we would do would just deduct the proceeds from the pool and just leave it at that. But yeah, for full expensing, it could create a balancing charge on disposal rather than waiting until cessation. So let's have a look at these assets and we decide what we're going to do with them then. So on the 1st of January 24, we have a car with carbon dioxide emissions of 165 grams per kilometre. And there's no private use of that. Now this is a company, so we don't have to worry about private use. If this were a sole trader, then if the owner of the business was using the car for private purposes, then there would be an impact on the amount of capital allowances we could claim. But this is a company, so we don't have to worry about that. But what we do need to worry about, though, is which column should we include this in? Could it be a first year allowance? Well, no, because it's got more than zero carbon dioxide emissions. So let's have a look at the reference materials to guide us for this. So we've got more than 500 grams per kilometre. So that means we're going to have a 6% writing down allowance, and that puts this car into the special rate pool. So we've got 1st of January 24, 60,000. So let's put that in our special rate pool. So we've got the 1st of January 24, but the car is 165 grams per kilometre. So that means that the full 60,000 goes into the special rate pool. Next then, we've got our plant on the 8th of October. So this is going to be used in the business for 10 years, then sold for 50,000. It's got a cost of 400,000. So what should we do here? So it's plant, but there's nothing there about it being second hand. So it could go into either the annual investment allowance or into the full expensing. So remember the question said we should take the most advantageous route for this. So where would we put it? So given that if we put it into the full expensing column, it could create a balancing charge on disposal, then it would be more advantageous to put it in the annual investment allowance column. And that means all of it could be written off for tax purposes in this year. Okay, so those are the two assets that relate to the first of the two periods. There's still one more asset to deal with, but that goes into the second period. And then we've also got this disposal on the 16th of May. So there's an electric car with 0 carbon dioxide emissions. So we would have had a first year allowance for that. Again, there's 50% private use by the sales manager, which is irrelevant because this is a company, not a sole trader. And we have the proceeds of 8,600. So we have our disposal on the 16th of May. So which column are we going to put it into? Well, given that it was a 0 emission car, we would put that in our first year allowance cars column. But yeah, there's no brought forward balance. Yeah, this column is empty so far. So what we need to do then is allocate that to the general pool and deduct the proceeds from the general pool. And that's just going to make our written down allowance for the year smaller. Remember, if the general pool had been 0, this would have created a balancing charge now. But it's not 0, so we don't have to worry about it. Okay, so what we can do now is start working out some of our allowances. But before we do that, we'll need some subtotals though. So let's put our subtotals in for the general pool. We have 147,400. And for the special rate pool, we have 142,000. Okay, so those are our subtotals. And then we can work out our allowances. So first of all, let's work out our annual investment allowance. So we can take the full 400,000 that we spent on that plant, and all of that can go straight into our allowances column. And then we've got our written down allowances at 18%, and we'll also have our written down allowances at 6% for our special rate pool. So we just take the subtotal, the 147,400, multiplied by 18%, and that's going to reduce our pool by 26,532. And all of that can go into our allowances column. And then for the 6% in the special rates, we take our 142,000 times by 6%, and that gives us a writing down allowance of 8,520. Remember, we don't have to worry that there's personal use here, so we can put the full amount into the final column. But let's suppose though, while we're revising this, let's imagine that this was a sole trader and the owner had this car and they had some personal use. So we'd still deduct the full 8,520 from the pool, but when we work out our allowance, we would then multiply that by the amount of business use. And we can only have an allowance for the business use proportion. So deduct the full 100% from the pool, but only add the business use to the allowances. Okay, so we've done that now, so we can work out our totals. So we have a total allowances for the year 435,052. And now our special rate pool has gone down to 133,480. And our general pool has gone down to 120,868. So that's going to be our tax written down value, which we're going to carry forward into the next period. So let's move on to that next period now. So we've got our tax written down value brought forward. So we can see we've got 0 for our AIA, so that's nothing for us to worry about here. And maybe we're just copying the figures, aren't we, from the previous period. We've got no disposal in the second period, do we? But we do have at our other addition, don't we? So let's have a look at the addition. So on the 15th of January, we've got a car with carbon dioxide emissions of 35 grams per kilometre. Again, that's in private use by the production manager, an employee, so we don't have to worry about it. Okay, let's see which column we're going to put this into. So with 35 grams per kilometre, that's emissions up to 50 grams. So that's going to go to the general pool, getting 18% capital allowances. So the full 24,000 can go into the general pool. So that's the 18th of January, car with 35 grams per kilometre. Okay, so there's no disposal for us to worry about here. So yeah, what we can do now is just work out our subtotals. We've got 144,868 in the general pool, and we've got 133,480 in the special rate pool. So again, we want our writing down allowance, don't we? So we've got 18% for the general pool, but remember this is a short period. It's only for 4 months. So we want to time apportion that with 4 months. And similarly, we'll have a writing down allowance with the 6% for the special pool. But again, we want to time apportion that for 4 months. So for the general pool, we take the 144,868, multiply by 18%, and then time apportion for the 4 months. And that gives us a writing down allowance of 8,692. And the full amount of that can go into the final column. And then for the special rate pool, again, it's only 6% this time, but remember we need to time apportion. So we get 2,670 with a little bit of rounding there. Again, the full amount can go into the final column. No need to worry about private use for an employee. So that means our total capital allowances for the second period is 11,362, and then we can work out our tax written down values, can't we? And we're going to carry forward into the next period. So we've got 136,176 for the general pool and 130,810 for the special rate pool.